After one of the strongest and broadest rallies across every major asset class during the first half of this year, asset class returns have been more modest during the third quarter. The FTSE All-World Equity Index gained by 3.3% in sterling terms and by a meagre 0.05% when viewed in US dollar terms. Global bond markets in sterling rose by 4.46% and by 1.14% in US dollars. Leading economic indicators have deteriorated as the trade war between the US and China escalated, whilst business and consumer confidence, albeit from elevated levels, has turned down sharply. The outlook is not expected to change much in the near term, as the current economic expansion appears decisively late cycle. The good news is that global central banks are on alert to inject additional liquidity, and fiscal support could be on offer again. At the same time, non-manufacturing activity and consumer spending remain robust and should continue to benefit from the combination of low levels of unemployment, positive real disposable income growth, and loose monetary policy. With regards to asset allocation, we remain neutrally positioned to global equities. Valuation multiples have re-rated, and the near-term outlook for earnings growth is not expected to improve much from current levels. The gap between valuations and earnings has widened as investors position themselves for an improved outlook, but this could easily narrow again if growth disappoints. Government bond yields have declined sharply, which has proven to be an important underpin to equity valuations. Although we are cognizant that interest rates are on a downward trajectory, we believe bonds remain expensive and provide investors with little margin of safety at current yields. Hence, our preference is for cash and short-dated money market instruments over long-dated bonds. Client portfolio results continue to please, with returns ahead of or in line with benchmarks, except for lower risk and fixed income mandates, which have lagged due to our defensive capital preservation short duration strategy. When viewed against peer group, 1, 3, and indeed 5-year relative returns pleasingly highlight continued strong outperformance. Going forward, investment returns will very much depend on the path of global growth. The geopolitical backdrop has become increasingly uncertain and remains the single largest risk to the pace of economic expansion, something that investors do not have much control over. We therefore predict increased volatility in the final quarter of the year, and as such, we continue to focus on fundamentals, ensuring that all portfolios are adequately diversified and that asset allocation is in line with our clients' long-term investment objectives.